Hello and welcome to Wall Street Training's LBO Leveraged Buyout Overview course. Please note that these materials are copyrighted and may not be disseminated or reproduced for any reason without express written consent from Wall Street Training. Wall Street Training provides financial modeling, valuation modeling, mergers and acquisitions, merger and leveraged buyout modeling, training to corporations, as well as through public open enrollment seminars and self-study video-based learning. My name is Hamilton Lin, President and Founder of Wall Street Training, and I will be your instructor throughout this course. My background is primarily in investment banking and mergers and acquisitions, having worked at Goldman Sachs' investment banking research, Bank of America Securities' mergers and acquisitions group, and several other smaller boutique investment banks, again all focused on mergers and acquisitions. Personally, I have executed a fair amount of LBO transactions ranging from as small as $10 million to over $6 billion. I am a CFA charter holder as well as a CFA instructor. The goals of this course is to provide a basic overview and introduction to leveraged buyouts, including a discussion and rationale of going private, the ideal LBO candidate, as well as drivers of value. We will also discuss the following items, including a description, importance, and implications of various items such as valuation, debt capacity, scenario analysis, sources and uses of funds, role of equity, and capital structure. We will also spend a little bit of time focusing on purchase accounting versus recap accounting, goodwill treatment, and other issues. You will be able to gain a fundamental knowledge required to understand leveraged transactions after you are done with this basic overview. To hone the concepts learned on this module, please be sure to follow up this course with our quick and dirty basic leveraged buyout modeling and, of course, our complex leveraged buyout modeling course. This does currently assume that you have a basic understanding of accounting, fundamental concepts in finance and valuation, and we highly recommend prerequisites to this course include our accounting and financial statements integration, our Finance 101, and our corporate valuation courses at a bare minimum. Let's now turn our attention to the very first slide. What is a leveraged buyout? A leveraged buyout can be thought of through the following analogy. Leveraged buyout is simply using debt to buy something out, hence the word leverage and buyout. Now, you can akin this to the following analogy. Let's say you are buying a real estate property. Let's say you're buying a real estate property and the current owners of this property, let's say, currently have an 80% equity stake and they have yet to pay off the remaining 20% of the mortgage. You come in here and you borrow a massive amount of debt and you put down, let's say, anywhere between 10 to 20% to purchase this property, and you put down and you borrow anywhere between 80 to 90%. This is the leveraged buyout portion. Then you will use the internally generated cash flows. Key is the internally generated cash flows to pay down the debt and build equity. Build equity such that by the time you're done, your equity stake, not that this is drawn to scale, but pretend that there is no appreciation in the actual asset, but you will be able to build your equity up to the point using the internal cash flows generated to pay down the debt. And this allows you to now own a greater percentage of the company upon an exit or upon a sale. This is considered typically a financial transaction and usually sets the floor or the minimum valuation. Why is that? Because if a strategic buyer comes in theory, this is in theory now, they can also do the same thing and extract additional value if they're able to actually also provide economies of scale or cost savings or whatnot. Typically now, who is the private equity firm that is coming in? This is the person who is actually supplying the core capital, the equity base. Now, what is private equity? Think about private equities opposite the public equity markets. What's the public equity market? That's simply the capital markets, the stock exchange, etc. So therefore, the private equity markets are basically sources of capital, sources of equity that are from private sources as opposed to the public, general, John Doe investor, etc. Now, let's flip to the next slide. Leveraged buyouts basically provide a current market view of the range of hypothetical purchase prices by a third-party financial buyer. This is typically contingent upon several items. You must have an acceptable capital structure. You must have the right interest rate and return requirements for both the equity and the debt. We'll talk more about this a little bit. And also refinancing terms and whatnot. Typically speaking, and of course these targets will continuously change, especially as you meet different market trends in the current LBO cycle, but typically speaking, private equity firms like to generate at least a return of 25 to 30%. Here's a list of reasons why you might want to go private. Typically, LBO requires the buy-in of the management team. Hence, by the way, LBOs are sometimes considered MBOs for management buyouts, because you absolutely need the management team to go there and run the company, or bring in your own management team, because you do not want to be running a portfolio company because you have, let's say, several of these portfolio companies. You're not going to be able to allocate the time that's required to run the day-to-day operations. Hence, the reason why the management team is absolutely critical. Let's go into several reasons why LBOs are done. First of all, the public markets are not properly rewarding a company's true or intrinsic value. In this case, for instance, during the dot-com internet bubble, the quality, quote-unquote, old economy stocks were ignored and punished unnecessarily. In that case there, you might see that a lot of these firms, realizing there's a lot of internally generated cash flows, the valuations are depressed. We'll talk about the ideal LBO candidate in a second, and therefore the private equities might want to come in. Lack of a strategic fit with the parent company. A company may want to divest their non-core assets. Well, there's a perfect opportunity to do a leveraged buyout there and take it in-house within the management team. Similarly, there might be a lack of attention from the headquarters of the parent company, and therefore there's a little bit of disgruntledness, and that subsidiary might decide to say, listen, I want to get myself out and I can grow if I have the right resources. Hence, the parent company might decide to say, nope, don't want that, or it's not priority right now. Regulatory issues, antitrust dynamics. Many times you have consolidated entities in an M&A who might be forced to divest a part of the business so that they will not get too big, all due to antitrust dynamics. For smaller middle market companies perhaps, or privately held companies, a significant shareholder or owner might decide to retire, and this way this will pave the way for existing management team to potentially own the business through a leveraged buyout. Let's now take a look at the ideal LBO candidate. First of all, as we mentioned already, you must have an experienced management team. A strong CEO and CFO are absolutely critical. Why? Because the CEO is supposed to provide the strategy and the strategic direction, whereas the CFO is the numbers person. And therefore, they are the ones who are probably among the most critical, as well as, of course, making sure that the company is intact. So COO, sales, etc., marketing, all obviously very critical as well. Financial profile, this is pretty important. The company must have an ability to generate a steady stream of cash flows. If the cash flows are not there, nobody's going to buy the company. Why not? The private equity firms need to make sure that there's steady cash flow to pay off the debt so that their equity stake does not go to nil. The banks, the ones providing the leverage and the debt, they want to make sure that they can get repaid, so there must, once again, be a steady stream of cash flows. This is probably one of the most important attributes of an ideal LBO candidate. Why? Because these cash flows must fund the operations and continue to pay down the debt. In conjunction with that, there must be low debt balances, or there ideally would be a low debt balance. Why? Because therefore, additional leverage can be employed on this LBO. If you're already fully tapped out, and you can't do much additional with your capital structure, that's going to be a potential problem here, because if you already can't borrow additional funds to fund this leveraged buyout by definition, you might have a little bit of a problem there. High cash balances are ideal as well. Why is high cash balance? Because that, first of all, offsets the debt, but also you can use the cash clearly to actually pay for the actual leveraged buyout acquisition. In combination with all of these, you must also have a relatively cheap valuation. Why must you have a relatively cheap valuation? This way, if the public markets are undervaluing this particular entity and this firm, you can now go in there and you don't have to pay as much than if it were already fairly or overvalued. And therefore, from the perspective of the financial profile, it is very important to make sure you have all four of these components as much as you can. Also, there must be sufficient assets for collateral. Why? Because if it can be backed by assets, what you can do is the banks are going to be able to come in and be more comfortable loaning you the money. Because at the end of the day, banks being slightly more conservative than, let's say, the private equity folks, not necessarily the case, but generally speaking, they want their assets back as soon as possible. And if the company is not able to generate the cash flows, they want to know that their collateral is going to be worth something. And of course, you have industry factors that also influence operating risk. Do you have a competitive advantage over your competitors? Do you have a stable growth of demand? Is there high barriers to entry? What are the trends in regulation and impact on operations? All of these are key items to determine whether or not you have a good company here that's a good potential LBO candidate. Now, let's look at the true drivers of value. From where is the money actually coming from in a leveraged buyout? First of all, we already know that this is basically a massive stock buyback. You're basically increasing the amount of risk that you have because why? You're employing a massive amount of debt, to buy back the equity, effectively wiping out the entire current equity base and putting a significantly smaller percentage of equity on a relative basis. At this point here, you can also pause this video and refer to our exhibit on share repurchases, in which we describe in a regular share buyback, in a regular stock buyback program, you should have an increase in the stock price. Why you shouldn't have an increase if the financial markets and the capital markets are efficient. And again, in what circumstances are they going to be efficient? So please refer to that exhibit. Now might be not a bad time to do that. But generally speaking, in a massive stock buyback, you might see an increase in stock price for three qualitative factors. First of all, you basically reduce your shares outstanding. That increases earnings per share. Assuming constant PE ratio, stock price should go up. Behavioral effect. The management thinks the stock is undervalued, therefore they will buy low, sell high. And of course, basic economics, reduce supply, increase demand. However, if that's the case, again, we also prove in our share repurchase exhibit that there should be no additional value extracted. However, how is that going to be different from a leveraged buyout? First of all, you lower the cost of capital because you swap your equity for your debt. Now, this is potentially counterintuitive. Why? Because the required return on the private equity's capital is high. We said 25 to 30%. Whereas what you're doing is also leveraging the cheap source of capital to minimize your down payment. This is key, folks. What this means is your debt is going to be a smaller percentage in terms of the cost of the debt, the cost of capital. However, ultimately what you're doing here is, and this is the key, you are using other sources of capital to minimize. You're using other sources of capital to minimize the amount that you have to pay for this company. So if I said to you, I give you the opportunity to buy a huge mega billion-dollar company, but you pay $1, and in 5 to 10 years, the internally generated cash flows pays off the debt, and now the whole company is yours. Who's going to say no to that? No one's going to say no to that. Therefore, from that angle, what you look at it is to say the reason why the leverage buyout works is because you're buying an entire entity and not paying that much of your own capital, and you're going to use the cash flows generated to pay down the debt over time, such as your equity increases. This is different from a traditional smaller share repurchase. Why is this different? This is different because in a traditional smaller share repurchase, the equity base is still outstanding. You're not wiping away the entire capital structure. And again, we talk a lot more about that in our share repurchase exhibit. Again, using internal cash flows that are generated to pay off your debt to build equity. That is critical here. And of course, on a side tangent, this removes the company from public scrutiny, and therefore you don't have to worry about short-term results. As we all know, sometimes there's too much of emphasis on quarterly figures. And therefore, you can kind of operate your own company at your own pace without additional oversight that's necessary. Now, moving ahead, let's take a look at the different components if we were to build an LBO model. And of course, you will follow this up with our quick and dirty basic leverage buyout modeling as well as our complex modeling. Here is our LBO summary exhibit. In this LBO summary exhibit, let's go over the main components. We will look at each one of these boxes independently and in greater detail. First of all, you start with the illustrative transaction assumptions. You just kind of say, what kind of accounting are you using? We'll talk more about purchase versus recap accounting. What's the date of this acquisition? What's LIBOR, etc. Then you look at the critical valuation summary. In the valuation summary, you have to figure out what am I currently being valued at and what am I going to buy the company at. In this case, we're assuming a 20% premium. Additional debt capacity is very important. Additional debt capacity basically says what is the maximum amount of money you can borrow additionally to fund this leverage buyout. Then you have your sources and uses of funds. Your sources and uses of funds are absolutely critical. If you had to ask me which one of these boxes or which component of a leverage buyout would I want to analyze if I could only choose one, clearly without a doubt it will be the sources and uses of funds. Why is the sources and uses of funds so important? It's very simple. Where are you getting your money from and what are you using to pay? Where are you getting your money from and what are you going to use that money to pay off? I need to know that because I need to figure out this goes into deal structure, this goes into valuation, this goes into a whole host of issues, and everything in your leverage buyout model ultimately is dictated by your sources and uses of funds. Then we have our equity sources, where we'll talk a little bit later on about rollover equity. as well as goodwill calculation, as well as summary returns and credit ratios once you are done building the rest of your model. You would always want to build a sensitivity analysis. So here's the switches page that basically says, well, let me take this and let me start sensitizing and controlling how I want this model to work. In our complex leveraged buyout modeling, what's pretty cool about that module is one of the most complex leveraged buyout models out there. We give you the ability to toggle between status quo and a full-blown LBO. In our enhancements, a leveraged buyout enhancements course, we also build in stuff like picks, recaps, less than 100% purchases, etc., and we'll build all of that into our model as well. We also will want to sensitize our interest rate scenarios, as well as our refinancing scenarios, a brand new capital structure post-transaction, as well as, of course, our option information to really build as detailed of evaluation as we can. We will go into each one of these segments starting now. Now what we're saying is that leveraged buyouts are extremely sensitive to the cash flows produced by the core asset. We've already talked about that. As such, if building a detailed and comprehensive LBO financial model is absolutely critical to capturing and sensitizing all the various inputs. Major sections required to build an LBO, as we just talked about, are listed here. Why don't we take the time now to go through each one of these different boxes. Let's start with the valuation summary. The valuation summary, in a nutshell, models out the current valuation parameters as well as the transaction value. So you always want to look at status quo, how much is this company worth, that's the current, and then of course post-transaction, how much are you paying? How much are you paying? Okay, and that is the importance here. You want to properly estimate the acquisition price of the target company, and of course the implications should be straightforward. Too high of an acquisition price results in low returns. Too high of a price results in low returns, which is why the more undervalued you are in the public markets, the better and potential LBO candidate. Why is that? Simply because if you pay too much, you're not going to get your returns. You have to put in too much equity and you have to fund too much debt. So the lower you have to pay and the less you have to pay, the better off you're going to be there. Additional notes, you want to make sure that you properly account for options exercisable versus outstanding in equity value calculations. This is very important because that will have severe implications on the value of the firm as well as the cash flows that you have to pay out. And therefore, you want to make sure that this is done as clearly as possible. And take a look at our other basic modules as well as our advanced financial modeling for, again, a fuller explanation of options exercisable versus outstanding, and also our treasury method exhibit, treasury method of adjusting for diluted shares outstanding. Take a look at exhibit there for the actual math. In general, you want to include all forms of capital in your enterprise valuation: equity, debt, preferred, minority interest, etc. However, minority interest, which we talk a lot more in our corporate valuation course, you want to make sure that that is not actually paid for in your sources and uses. Now, let's quickly go on to the next slide, and then we'll talk more about the minority interest on that footnote there. Additional debt capacity basically says, if you recall, the whole purpose of this LBO is to do what? Try to fund as much as you can through debt, so you put down as little of your own equity as possible. Therefore, you want to try to figure out what is your additional debt capacity, the maximum debt that you can employ for this particular transaction. That, of course, is going to be absolutely critical because you, again, want to minimize the amount of equity that you put in. Therefore, you want to calculate your total debt capacity to estimate and maximize additional new debt borrowings. Why is this important? The higher the debt relative to equity, the higher the potential returns to the equity investors. However, there is definitely going to be an inflection point where the internal cash flows cannot pay out the interest. Therefore, you're not going to be reducing your debt principal very much, and you want to make sure that's why you're building a full complex model to see where is the point, where is the ideal deal structure that I will maximize my IRRs, my internal rate of return. Typically speaking, your debt capacity is determined by debt to EBITDA ratio, and these ratios, or another comparable ratio, is dependent on the current credit environment and is industry and sector specific. That's key, folks. Remember, as we said, this is a snapshot of the current market views of what you can do in the LBO market. Therefore, this is very dependent on the current credit environment. Is there tight credit? Is there loose credit? Etc. And it's very industry and sector specific, as there will be different parameters of gauging the level of debt depending on the industry that you are looking at. As we mentioned already, minority interest, as we talked about again in our previous courses, minority interest is excluded from debt capacity because you do not actually pay for the minority interest. And therefore, from that perspective, when we had said before, on our total enterprise value minus net debt equals equity value, and we had stated that our net debt includes minority interest. In this case here, we will not include it because it is not an actual form of capital that you have to physically pay for. It's an implied number. Please refer to our corporate valuation module for more information on that. Implications on this. The additional new debt capacity is dependent on whether or not existing debt is refinanced. If you refinance your existing debt, this means that your additional debt capacity is higher. You can borrow more because you paid off your old debt. But of course, you need additional money to borrow and refinance that debt. So therefore, there's going to be an offsetting factor there. Let's take a look at the next slide now, refinancing scenarios. All we're saying here is that you must build in a variety of refinancing scenarios to properly automate and sensitize your financial model. And the importance of this is you want to project this as much as you can to properly, again, sensitize. You have to understand the drivers of value and whatnot. So here we have, in this simple case here, 3 different refinancing scenarios. Here's our no transaction. That's our status quo. And here we have a very simple, we say no refinance. This means that all current debt stays. And then we say refinance everything, blow it all out. And of course, you have to pay additional financing fees as well as potential tender costs if you decide to refinance your debt. We'll talk more about that when we get to the expenses page. You could build in a super sensitivity analysis, right, to expand the functionality to a recapitalization, which is a massive share repurchase, right, a less than 100%. We actually do that in our complex LBO enhancement section. And of course, you can also choose to refinance selected tranches of a target's existing debt. Why is this important? Because refinancing scenarios will significantly alter the profitability and returns of an LBO. Let's talk more about tender costs and expenses right now. Tender costs. These are basically some of your more important expenses, definitions, and your accounting treatment. What are tender costs? Tender costs are what we would call the cost of tendering. Okay, that's very value added there, but basically it's a good guy premium for early repayment extinguishment of debt. Folks, what this means is that normally corporate bonds, etc., will not have a prepayment penalty for the vast majority of times. However, you have to instantaneously go back into the markets if you decide to refinance this existing debt. You have to instantaneously go back into the market and then borrow more money. So these institutional investors might be a little bit upset that now you're suddenly saying, well, hey, listen, sorry, folks, I'm taking out, I'm buying out, and you're going to lose that additional income now. And if interest rates have moved, then basically they may not get as much as what they had expected to get. Also, many times you will be required to refinance your debt upon certain types of control changes, which is all dictated in the covenants to each specific debt agreement. If you have to do that, then you have to pay what we call tender costs. And these tender costs are the costs of buying back the debt. Many times, again, you may not have to pay an explicit prepayment penalty. But to keep the institutional investors happy on the debt side, because you have to go back and tap into their capital right away when you do the LBO, you basically want to say, okay, I will pay you out for the interest, the present value of the interest that you would have received if this were held to maturity. But because we're forcing a repayment on this, we're basically going to go ahead and we're going to give you a good guy premium so that we keep you happy. Money talks. So therefore, many times also, you will end up renegotiating on a select one-to-one basis on how to renegotiate that refinance debt. That's fine as well. But typically here, what we're saying is the accounting treatment of this is expensed immediately. Why is this expensed immediately? You also have, by the way, accrued interest costs. So that's the cost of the interest that you have not yet paid, depending on if you're off cycle. Why is this expensed immediately? Well, because the debt related to this is no longer outstanding. Debt is no longer outstanding. And if the debt is no longer outstanding upon a refi, if the debt is no longer outstanding, then the matching principle of accounting says, well, you have no more debt, you got to expense it immediately. Transaction costs are fees incurred as part of the transaction, pretty straightforward, such as merger and acquisition, investment banking fees, legal fees, private equity fees, etc. For accounting purposes, this is considered part of the acquisition price. It flows through goodwill for purchase accounting. Again, transaction costs are considered part of acquisition price. In a purchase accounting scenario, which is the vast majority of LBOs, this will flow through the goodwill and increase to goodwill. Otherwise, for instance, in recap accounting or otherwise, this will be expensed immediately as well. Debt financing fees are fees paid to the banks for borrowing money. They will always charge you money to borrow. This is amortized over the life of the debt securities due to, once again, the matching principle of accounting. So this is a very basic overview of the three major types of expenses and their accounting treatment. When we go into our complex leverage buyout modeling course, we will go into this into a lot more detail, as well as how this affects both the income statement, the balance sheet, as well as the sources and uses and the entire leverage buyout model. Let's now turn our attention to the sources and uses of funds, one of the most important exhibits you can possibly find. Sources and uses, again, gives you a clear and concise summary of the sources of funds. Where am I getting the money from? Where am I getting money from? And uses is what am I going to pay off in this LBO transaction. One of the most important because this provides a detailed step-by-step explanation of where the money is going and where it's coming from. Typically, you would have, for instance, in your uses of funds, which is what you might calculate first, how much are you paying for the equity, how much are you refinancing of any debt if you are, as well as any additional fees. That's your uses of funds. Then you go back and say, well, based on the amount of capital I need, as well as your refinancing scenarios that we briefly talked about before, what this now says is what? Where are you going to get the money from? Your sources of funds. Well, I'm going to go ahead and get X dollars from my private equity firms, and I'm going to get Y dollars from the banks, and I'm going to use part of my cash, if I have any excess cash on the books, to fund this acquisition. Some notes on this. Typically, again, you start by calculating uses of funds. You decide whether or not to refinance existing debt. You add in other expenses, costs, tender costs, debt refinancing fees, transaction fees, etc. Then you calculate the sources of funds. Use the excess cash on a balance sheet, if any. That's really great. Why? Because you don't have to come up with your own capital. Use the company's own money to pay for itself. Any new debt borrowed, that's going to be key there. And of course, typically we will use the revolver to fully maximize the debt capacity. So we can maximize, here we'll say maximize our borrowings, which again ties back into our additional debt capacity, because that is where we will figure out how much money can we fully borrow. Now, I have a comment in here as well that there's an alternate approach where we say you will fix the equity contribution amount and then use the revolver to balance source and uses. We don't like this. This is less ideal. Why? Because we want to, again, maximize the borrowings. We'll talk a lot more about this in our complex leverage buyout modeling section. Now, going on to the next slide, let's talk about equity sources. This is going to be important here. Let's first look at the no rollover. Very straightforward. All we're saying is the following. We needed to borrow, we needed to come up with $4.26 billion to fund our LBO from equity sources. Now, this equity sources simply gives you a breakdown from the sources of funds. Where are you going to attain your equity from? What's important here is this will include or should include an analysis on whether or not the existing management team and or rollover equity invests in the post-LBO entity. Typically, the answer is yes for the management, because you want to continue incentivizing them. What is rollover, however? Rollover is an existing shareholder. Rollover is an existing shareholder that is different from the primary equity sponsor or acquired. This is a mouthful. Rollover equity is an existing shareholder who already owns the company, already has a stake, but is different from their primary sponsor. Why? What this means is the following. If you have a sponsor, an equity sponsor who comes in and says, well, I don't want to come up with all this 4.2, or rather, there's an existing sponsor who wants to stay in the firm, stay in the company, but I can't get rid of them. Why can't I get rid of them? Because they have too much of a stake and they might vote no against the deal. So in our example of yes rollover, what we're saying is the following. Let's pretend that we have a rollover equity who currently owns 6% of the company. They will roll all of their shares into the company. They will end up effectively owning 21% of the company post-transaction. In other words, let's go through the illustration on the bottom left-hand corner of this slide in a second. Let's go through the implications first. The more management and the more rollover equity, the smaller the ownership that the core equity holders will get. Why? Because you are basically sharing your proceeds and your profits. That sounds obvious, but here's the deal. The rollover equity folks essentially invest with pre-money dollars. They invest with pre-money dollars. They buy in at the company at a cheaper price. This also, by the way, affects the accounting treatment. So let's talk about that later on. We'll get to the accounting treatment section. Why is it that magic happens and you go from a 6% to suddenly a 20% equity stake? Let's take a look at the numbers. Let's say you buy this company and you pay $14.8 billion for this company. You need, per your LBO sources and uses, $4.2 billion of equity. In the no rollover scenario, there is no rollover, 0%. What that means is, how much is the rollover equity contributing to that purchase price? Zilch. Zero. How much do you, the primary equity sponsor, have to contribute? The full $4.26 billion. What this means is you, the primary equity sponsor, owns 100%. The rollover owns 0. That's straightforward and that's pretty obvious. Now, let's look at it with the rollover. What we're saying is as follows. You are buying the company out for $14.8 billion. You need a total of 4.26 new equity to buy out all 14.8. Rollover currently owns 6%. So they will contribute all of their 6% stake into the new company. How much does that equate to? Well, listen. The whole company is currently worth $14,871. They own 6% of that. Therefore, their 6% equity stake is worth $892 million. So what that means is you are not going to have to buy them out. Again, this 892 you're saying not have to pay for. But they still get value. How much value? Well, they get the exact same 892. So what they say is we will now put in our $892 as if. This is similar to saying as if you went and found another buddy, another private equity sponsor, said, give me $892 million bucks, and you'll be one of our private equity sponsors in this deal as well. And of course, you see plenty of that going on these days with the massive amount of consortiums, private equity consortiums that are pulling together to buy massive amount of massive size companies. So here what we're saying is your $14.87 billion is at a 6% stake, you have $892 worth of value. But I'm not paying you for that value. I'm the private equity primary sponsor. I'm not paying you for your rollover 6%. Therefore, I will allow you to roll your $892 million into the new entity. Therefore, if I had to pay $4.26 billion, and you are contributing 892 of that, how much is the amount of equity that I got to put in? Simply the difference. And if the difference says I only have to put in 33.68, therefore, of this 33.68, the entire new equity is 42.60. I will effectively end up owning 79% of the company, which means you, the rollover, will now end up owning 21% of the entire company. So that's how your 6% stake on a pre-money valuation, because now it's the same dollar amount, 892, but of a significantly smaller percentage of the equity pie, you now own a significantly greater stake. That is the advantage of being a rollover equity. Yes, they could decide to cash out, take the $892 million bucks, and run for the door. But if they see the value in the LBO going forward, they may decide to say, let me stick my money inside the LBO because now I'm going to make another series and another layer of returns potentially. Again, the rationale, the explanation is the private equity sponsor is not buying out the rollover and therefore does not need to pay the $892 bucks, which is now a part of the new equity sources. This means that the equity rollover is pari passu, the same equal footing as the primary equity sponsor. That is what rollover equity is. Again, that's also going to have serious implications on our accounting treatment if you decide to try to elect to get recap accounting. We'll talk more about that. Let's first quickly talk about our interest rate scenarios here. Our interest rate scenario says the following. You just want to quickly sensitize. All you want to do is sensitize the model. Why? Because of the high amount of leverage employed. The high amount of leverage employed, any small change in interest rates are going to have severe implications on the cash flow. And you want to therefore make sure that you build in a full interest rate scenario to make sure that you have properly accounted for the sensitivity, worst case scenario, and whatnot. Pro forma capital structure is simply a snapshot comparison of your actual pre-transaction versus your estimated pro forma capital structure. This is important. Why? First of all, you're going to have a side-by-side comparison of your debt profile. This is important because this serves as the beginning point for your pro forma opening balance sheet. This goes into your balance sheet, very important, and this drives the entire debt sweep. Very, very important here. So this is just a snapshot of, after the transaction, what does your pro forma capital structure look like? Pretty important there. And this, of course, can only be created after your sources and uses are done, because you need to now, as well as, by the way, your refinancing scenarios, because you need to figure out, well, this is how much they are worth. This is how much their capital structure is split. Okay, let's talk about purchase accounting versus recap accounting. Now, on the left-hand side, acquisition purchase. What we're saying is, what if we did an outright acquisition? In an outright acquisition of a company, a new legal entity is created, which means that the target firm is blown out, there is no longer in existence. You will raise new debt, you'll be buying back all the shares, and the new equity is simply the private equity firm's equity injection to combine. What this means, again, as I mentioned, the target's balance sheet is blown out, and yes, you have goodwill that is created. Now, for a little bit more information on this upper left-hand box, please feel free to go to our Mergers and Acquisitions Deal Structuring module, in which we describe this treatment of goodwill, stock versus asset deals, stock versus cash consideration, and whatnot for more information here. This is just going to be a teaser on this, which we'll go into a lot more greater detail when we actually build our complex leveraged buyout model. So again, let me reiterate this. The acquisition or in a real purchase, you're buying out the entire company and the old company no longer exists and goodwill is created. Those three key points. Let's take a look at the upper right-hand corner, recapitalization. A recapitalization simply says, let me recapitalize or let me redo my capital structure. It's a modification to the current capital structure. You have incremental changes. No new legal entity is created. The target firm is still in existence. And what you're saying is you are not buying back all, but rather you're buying back some of your shares. This is a massive share repurchase is what we're saying. How do you fund that massive share repurchase? You raise new debt. What you will have is, instead of blowing out your target company's balance sheet, you will simply have marginal changes. Again, this is sort of like a day-to-day share repurchase, if you will, except it's a large day-to-day share repurchase. And because you're not buying the company, this is not an outright acquisition, no goodwill is created, you're not purchasing the entire company. So again, hopefully now, on the left-hand side, you have a true acquisition, you have outright acquisition, the existing target firm is blown out, and the entire balance sheet is gone, and goodwill is created. In a recapitalization, you're not actually buying the company, you're simply modifying the current capital structure, you will raise debt, buy back shares, no entity is created, and you're just going to have changes to the balance sheet as if it was a regular day-to-day share repurchase, although a very large one. Now, as we have mentioned also in numerous scenarios and numerous examples in our M&A deal structuring and merger modeling courses, which would follow after this particular overview of leveraged buyouts, we talk a lot, again, about is there a scenario where we can have the best of both worlds? That was mentioned in our 330H10 election in our merger modeling course. In our recap accounting, what we're saying is, and this basically doesn't happen very often anymore. Doesn't happen very often anymore. But the reason we go over here is for two reasons. Number one, there's still a possibility. And here I would say you must consult your professional attorneys and tax accountants. You must consult your tax people. The second reason why we want to look at recap. The first, again, was it still might happen. You will consult your tax professionals and accounting professionals. And the second reason why is because in the building of our model, our complex model, we will need this for our status quo toggle, which we will explain further as we get into our model. In a recap accounting, what we're saying is this is a full leveraged buyout acquisition. In other words, everything on this box now being circled in black, that will apply here. However, what we're saying is, well, you can actually elect to get recap treatment. How do you elect to get recapitalization accounting treatment? First of all, what are the reasons why this is good? No goodwill is created. This is not, by the way, this is not pooling of interest, FASB 141, which got rid of that. This is not. Okay, completely separate. No goodwill is created, and you get to have a cleaner balance sheet because there's no goodwill, but you will end up with massive negative equity book value. And I'll go through that in the next slide. We'll go through a short example. How do you get recap treatment? Very simply stated, you must have rollover equity in which 5.1% of the existing shareholders roll over the equity. Specifically, the actual rule is the rollover equity must not be the acquired, but rather the acquired cannot buy more than 94.9% of the shares. Again, if you meet this 5.1% threshold, what we're saying is we'll give you this recap treatment as if you just recapitalized, bought out the other 94.9% shareholders, and bought in a new equity stake. That was the magic 5% number, or greater than 5%, 5.1. What are the advantages, again, of doing a recap accounting treatment? Number one, you do not create goodwill. And number two, for purposes of our model building, this will allow us to easily sensitize our financial model, our LBO model, to actually have a status quo toggle to say, don't do anything, no transaction, keep it as run rate valuation. So let's take a look at how this recap and treatments would be affected. Actually, right before we do that, let's take a quick look at goodwill calculation first. Goodwill, one of the key things that we're trying to avoid in our purchase is the fact to say goodwill is simply excess purchase price. We should know that already. It's the purchase price minus the book value. That's the excess that you are paying, and basically says that depending on your accounting rules, purchase price allocation and write up or step up to fair market value of the assets, this will decrease goodwill. Remember, goodwill is a fake asset. It's backed by nothing, so we don't like it. Now, generally speaking, you want to minimize goodwill because, again, it's a fake asset. Goodwill is definitely created on purchase accounting in a stock deal. And, of course, as we mentioned previously, in expense treatment, transaction costs are added to goodwill since considered part of purchase price. However, in a recap counting, you're not actually blowing away the entire company. You're not acquiring it from a purchase price perspective. Transaction costs are therefore expensed immediately. And as we talked about very, very briefly, in FASB 140, 142 on our merger modeling courses, goodwill is not amortized for GAAP purposes. Let's take a real quick look at the amortization of goodwill, FASB 142. Here, again, I will actually defer you to our M&A deal structuring course. Our M&A deal structuring course where we expand upon this and walk through this step by step. Pro forma, opening balance sheet and adjustments. When you go ahead and look at your balance sheet, you will have to make certain adjustments. That is usually the key here and the most annoying and difficult part of your pro forma balance sheet. First of all, you will have a reduction in cash. Why? Because you will use it to fund part of your acquisition in your sources and uses. You will have additional, in this case here, this scenario was a purchase accounting. So with purchase accounting, as you already know, you have goodwill created. You have additional financing fees that you now have to amortize and put on the balance sheet. You have increased revolver, increased additional debt, and you have changes to your equity account because you're basically saying blow out your existing equity and then add in the amount of new equity that you have raised from your private equity sponsors. Here now on page 26, let's go into additional detail on purchase accounting versus recap accounting, left-hand side. As we said with purchase accounting, you will blow out your target accounts, blow out your equity. This is your equity accounts. What that means is you will start off, you will take your existing actual balance and you will minus that balance. Why? Because you're blowing it out. Zero, it's gone. Kaput, zilch, not a zip, gone. Therefore, it's gone. What will you add to that? Very simple. The amount of equity you raised from your sources and uses. This is your private equity sponsor contribution. Okay, that's how much money they're putting into the company. So simply stated, your pro forma balance is your equity amount from your sources and uses. Very straightforward. Retained earnings. Again, you will say, well, blow out your existing balance. So you start with your actual and you blow it out. Then as we have mentioned with our expenses, you will expense your tenant costs immediately. Why do you expense it immediately? Only if your debt is refinanced because that debt is no longer outstanding. Therefore, what we're saying here is zero. If you're not refinancing, in other words, fresh start, you have a zero pro forma retained earnings balance. Effectively, you've wiped away your entire balance. Recap accounting, we were not blowing out our target account as we did here. What are we doing? Marginal changes only. We're not buying the whole company. We are actually, but the accounting treatment says what? Start with your actual balance. Pretend you did a massive share repurchase. How massive? Well, 94.9% at least, or at max. So you start with your actual balance and you minus the amount of equity you purchase from your sources and uses, from your uses in particular. That will be that $14+ billion, 14,871 if I'm not mistaken. To that, you're saying, I will buy back $14+ billion of equity, and how much am I putting back in? Let me erase that. This is a positive sign, so what we're saying is we are putting back that $4.26 billion that we're putting back into the company. So again, this is why it's the difference between the equity purchase and equity injection. This is a big, big negative number. Why is this a big, big negative number on the recap accounting? Because you're buying back a huge amount of stock and you're putting in a lot less of additional equity. The retained earnings balance is somewhat similar. Again, recall in purchase accounting, you blew away your existing balance. However, in the recap, you do not. You take your current existing actual balance and you just make marginal changes. Again, you make marginal changes. Marginal changes. What are the marginal changes? Transaction costs. Because if you recall, transaction costs here are actually part of goodwill in purchase accounting. So if that's part of goodwill, in the recap accounting, we're not actually creating any goodwill. Because we're not creating goodwill, these transaction costs are expensed immediately, as are tender costs, as we talked about under purchase accounting as well. And therefore, your pro forma balance is the existing balance that you started with, less any additional cost. These are marginal changes only. And that will be important because why? Again, no goodwill created under recap accounting. No goodwill created. And you will see when we build our complex leverage buyout model and when we get to the pro forma balance sheet adjustments, how exactly all of this will still continue to balance and equalize itself. Let's quickly look at our cash flow statement now. There's not too many additional modifications to the cash flow statement. You will first of all have to amortize your debt transaction fees. That's a non-cash cost. That's a non-cash that you have to expense in your income statement, which lowers your net income, which is the beginning point for your cash flow from operating activities, but you do not have to pay for it in cash. When did you pay for it? You paid for it when you bought the company in your sources and uses. Also, adjusting for cash flow from financing activities basically says if you are paying existing dividends, don't pay any existing dividends unless you are building that in, but that's a different story. That's on your IRR return analysis as well. But basically, if you are going to ignore regular common stock dividends that you have paid before, then you have to make sure that gets wiped away. In addition, if you have any additional new dividends that you do want to pay specifically to the private equity firm now, then go ahead and build that in. Any PIK paid in kind, you also have to pay that. You also have to incorporate that again because why? This will increase your interest expense, decrease net income on income statement and cash flow statement, but of course this is a non-cash accretive security as well as payment. Also, if you in the past had a share repurchase program, you also have to get rid of that as well. So you need to make that type of adjustment. In the debt suite, we'll also look at something similar. You will have to include all new debt from sources and uses. You have to include all new debt and flow it through this debt suite. So for instance, you also have to make sure you have term loans that are amortized over time. You might have a pro rata principal repayment or 1 or 2%. You must also decide, hey, let me not repay all of my debt as soon as I can and whatnot for whatever reason. And of course, any PIKs must be also accreted appropriately and whatnot. So you do and will have adjustments to your debt suite. And real quick, ratios. What we're saying here is as follows. You always need to evaluate your ratios. Very important. Why? Because your debt ratings are going to also dictate the amount of debt and the percentage of the interest rates. Therefore, for instance, what we're saying is on a pre-LBO and a status quo scenario, this is what our firm would have been at, rated, let's say, somewhere around BBB and A. And of course, once you do a highly leveraged transaction, obviously your debt profile is going to increase significantly, and now you'll be rated significantly at a lower percentage or lower credit rating. Last but not least, our internal rate of return calculation. All we're trying to do is trying to calculate the end result to the equity sponsors. At the end of the day, show me the money. What is my return for the dollars that I am putting in? And of course, don't forget about management stakes, rollover equity, management option pools, also warrants, convertibles, etc. PIKs paid in kind as well as dividends, all must eventually be incorporated into this analysis. But all of this is saying very straightforward. Let's go through this very quickly. We will value the enterprise value off a multiple of EBITDA, and we will have calculate down to our equity value, calculate down to our percent pro rata. In this case, we didn't own 100% because we did have rollover, as we talked about before. And of course, ultimately, what's your IRR and what's your multiple of capital to the equity sponsor. Now, that again just wraps up our leveraged buyout overview. I know we went through this pretty quickly and there's a lot of information to soak in at once, but this is meant to be a teaser and an introduction to let you know and to let you be aware again of the basic overview and introduction and the types of things that one must begin to look at when evaluating a leveraged buyout or building a leveraged buyout model. Now, if you would like to, you can turn your attention to our quick and dirty basic leveraged buyout modeling, in which we build a very simplistic model to, again, reiterate some of the core concepts of the leveraged buyout, as well as then after you have gone through some of our additional financial modeling and advanced financial modeling courses to also then build our very complex LBO model. Take care. See you soon.